But do take note that those are not the recommendation, because some of the ETF I show would not be suitable to many of you, right? But some of them will be suitable, some of them not suitable. I am a licensed financial advisor, so do take note that if you need any special or personalized financial advice, you can approach me separately, right? More importantly, do not take all the ETF here at a face value and invest uh, accordingly. Okay, so as an investor, one of the most challenging thing that we are always facing basically is the stock picking, right? It's not easy to do the stock picking in this investment world. I started off investing doing the stock picking, and most of the time there are a lot of things we are not within our control. For example, when Trump says something, when the war break out, no matter how good is in your stock picking, those are external noises, and also the Federal Reserve, when they just change the direction of interest rate, we have a lot of macro event that can derail our investment. All right, so having the individual stock investing, we are exposed to the idiosyncratic risk. Okay, so basically what does it mean? That basically these are the non-systematic risks and stock related. This is something like when you go to the supermarket, you pick some of the apples, right? Do individual apple picking, and you have a high tendency of picking the rotten apple. And if you are just using all your money to buy one apple, when the apple is rotten, basically you lose your all investment, right? And also mathematically, if you're investing holding on a single stock, when the share price drop by 50%, you need to recover 100% in terms of stock price in order to break even. So basically, picking an individual company exposes a portfolio to a concentrated failure. And this is one of the things that investors should take note. That's why diversification is the only strategy can help us to minimize losses and also manage our portfolio volatility. This is where the ETF come in nicely, right? Instead of buying a single apple, when you are using the ETF instrument, basically you are buying a whole basket of a pre-packaged fruits. It can be anything. It can be many apples, maybe 100 apples, 200 apples, or maybe some of the ETF you give you the exposure to apple, orange, grapes, and so on and so forth. Those considered are different asset classes. So only ETF are able to help you to invest in the basket of the underlying asset class. It can be the fixed income, can be the bond, and can be the equity. And this will help you to minimize the potential losses if you make the mistake. All right. So choosing an individual stocks, you have an exposure to 100% losses. But when you are investing in a basket of stock, uh, unless the whole market crashes, unlikely all your underlying of maybe 100 stocks actually go down to zero. So this will protect your downside by investing using the ETF. So these are the comparison table using the ETF versus the single stock picking, and also the active unit trust. And these are the most common question that investor, they are not sure, because we have many ways to invest in the stock market. You can do the individual stock picking. Of course, you need to understand the fundamental analysis. You need to analyze a chart, technical analysis to help you to time the entry. And there's exposure to the idiosyncratic risk, and it's pretty risky. But of course, when you're doing the DIY, doing the stock picking, your total expense ratio, basically you don't need to pay for any fund manager when you are investing in the stock picking, right? And no one to help you to manage, only yourself. And in terms of trading flexibility, you can sit in front of a computer and trade the intraday or interday. And you have a very uh, holding. You can see all your holding because you are the decision maker, select the stock itself. And when you're holding the single stock, you are able to lend out your stocks. Okay, for example, you can lend out the stock in your CDP account to someone who shorted the market. And from there, you can get some maybe interest from lending out the stocks, right? But for active ETF, basically active ETF refers to there is a fund manager behind the scene. For example, BlackRock, JP Morgan, Lion Global, Amoa, those are the fund manager that can issue the unit trust, and the fund manager behind the scene, they will do all the stock picking for you and help you to manage your portfolio for you. It's pretty low risk because unlikely the whole portfolio you go down to zero, but because you are engaging a fund manager, there will be costs involved, right? And one thing do take note that the unit trust pricing is the end of the day pricing. You don't see the price changes throughout the whole day. They can only conclude the unit trust net asset value by the end of the day. So when you want to buy the unit trust, basically you'll be using the end of the day pricing. And in terms of transparency, uh, normally the fund manager will only show you the top 10 holding in their fact sheet, all right? And the rest of the underlying, you do not know what are the stock they are holding, what is the percentage, you will not know. Most of the time, they only show the top 10 holding. And unit trust is not retail lendable. Okay, in terms of the ETF. Okay, ETF basically is passive in nature. Okay, so what does it mean by passive in nature? They do not have a fund manager behind to do the active trading or active stock picking. Most of the time, the ETF will follow the index. Okay, and it's pretty low risk, and the cost is pretty low because you don't need to have any active monitoring, active trading, and ETF can be traded every day. That means once the market open, you can see the price changes on the ETF itself. And 100% transparent. Later, I'll show you where to get the information, how to what are the holding the ETF they are having. And ETF is lendable. Okay. So basically, in short, ETF combine the diversification of the mutual fund. Okay, this is very important for the investor. If you do not want to lose your capital hugely or have a big drawdown, it is very important to do a diversification in terms of portfolio. And ETF also provide you the intraday liquidity. Okay, that means that if you can buy today and in the morning, and after that sell in the afternoon. You can trade the ETF, right? And this is a very cost efficiency of buying multiple stock at one go. Okay, at the present moment, the whole Singapore market itself, we are reaching close to 20 billion Sing dollar. ETF has been on an increasing growth trend for the past few years. So and the other important thing is why the investor come into this region is due to the strength of the Sing dollar, because Sing dollar is the AAA credit rating. So there are a lot of institutional money come to park in the Singapore stock market, and also to preserve the capital. Okay, so ETF, there are three party in the ETF. Okay, first of all, of course, the easiest one is an investor like you and me. We can buy the ETF on the exchange. We can trade the ETF on the exchange as long as the trading hour is open. There are another two more party in this equation. One is the person, the authorized participant to trade on behalf of us. Okay, basically the assemble the basket, the AP, buying the underlying index stock and also delivering them to the ETF sponsor. ETF sponsor, you issue the unit to us. So when we buy the ETF, basically we are buying the unit from a sponsor. We are not buying from a stock market. Later, I will show you what example. What do I mean? Okay, I repeat again. When you are buying the ETF, we are not buying the stocks directly. We are buying the unit from a sponsor directly, and this sponsor basically they work with the assembler to buy the stock by themselves. Okay, this one is 100% copy of the underlying. Okay, do take note when you are investing in the ETF. There's another asset class of the ETF called synthetic ETF. Okay, so when you see the synthetic ETF in the description itself, synthetic does not mean basically the AP itself they don't buy from market itself. Okay, basically they may be using some financial derivative or contract to replicate replicate the underlying. Okay, so directly or indirectly, you don't own the underlying stocks. Okay, so this is an example of the STI ETF. So the sponsor is State Street Spider. State Street Spider, and this ETF is a straight time index ETF. This ETF represents the top 30 stock in Singapore. All right. The top 10 holding, DBS holding, the weight is 26.6%, OCBC 16%, UOB close to 10%, Singtel, SGX, Singapore Technologies, CapitaLand Integrated Commercial Trust, this is real estate, okay, Singapore Airline. So the weight here is, you can see that actually the whole STI index itself is heavily skewed to the bank. Okay, so when you are investing in the STI ETF, you need to take note that 50% of the ETF basically they are skewed to the bank. All right, and you only have another 50% have a diversification into a different sector like telecommunication sector, financial sector, industrial sector, and so on and so forth. Okay, so this on the left is the ETF. And this ETF will follow closely the STI index. On the right-hand side is the STI index. Okay, so you can see from here there is a difference between the index weightage, right? In this case, DBS holding in the ETF is 26.59. In the index, the weight is 27.27. OCBC 16.02%, and in the index is 16.43%. Okay, so what does it mean? That means that there is always a lagging effect on the index and also the ETF. When the price changes on the holding itself, the one who go and buy the stock itself, they try to replicate as close as possible. So there is always a delay, and also there's always a difference. The delay and difference is called the tracking error. So one of the key things that investors should take note that we need to look at the tracking error as close as possible or as small as possible. Okay, now I will show you the website where to get this information. All of you, you are able to go to the website and do the research for yourself and get the information. Okay, now I switch to the website. Okay, you Google it, you should be able to get this for the STI ETF under State Street Spider is ES3. If you want to buy this ETF, again, this is not a recommendation to take note, all right? I'm just using this one as an example. You can just enter this sticker symbol on Straight Spider STI ETF. And you can see from here under the fact sheet or the fund manager website, you can see the past performance. So STI has been doing quite nicely. It's on an uptrend and recently has increased exponentially. All right, whether this trend can continue the uptrend yet to be seen. And do take note that why this ETF has been on the rising trend recently, because the top 3 bank in Singapore has been performed fantastically. That's why you are able to see this uptrend. When there is a correction or when there's a sell-off of the 3 banks in Singapore, you can see that the STI ETF, you're most likely to be dropped, okay, drastically when there's a huge sell-off. And when you click on the holding itself, you will be directed to the holding itself. Okay, to see the top 30 holding, right? You just click on this daily. Then you are able to see this Excel spreadsheet, all the 30 holding under this ETF. You can see the DBS here, OCBC, UOB, so on and so forth. And you have some other stocks like for example, CapitaLand Invest, L Group Limited, Capital DC, and so on and so forth. right? So the ETF is transparent. You know what are the underlying under the ETF. So this is a very good way for you that for you to diversify and you are know what you are investing, right? And you also can check the an overview what is the dividend payout by this SDI ETF, right? You just scroll through it and you should be able to see what is the net asset value from this ETF. For example, if you want to buy one share of this ETF, one share worth $5.21. If you want to buy 10 share, you'll be multiplied by 10, $50.21. So investing in ETF is very, very affordable. Okay. And the distribution yield for this ETF, 3.36%. Okay. They also show you some of the price to book, price to earning. This will refer to the valuation of the ETF itself. So these are the important things that investors should take note when you are evaluating the ETF. Okay, I'll move on to share that what are the key asset buckets on SGX, right? So the first one would be more on the local blue chip. Just I have shown you just now, STI ETF, they have most of the blue chip in this index. And the other big buckets will be on the real estate, right? Basically, if you are the investor, if you are looking for income, you want to have a passive income, you want to have an ETF which give you the dividend every quarter or every semi-annually, okay, you can look for those real estate ETF over here, okay. Most of the real estate ETF, basically, they are predominantly by the S-REIT. Okay, for example, you have a CSOP IHS REIT, SRT is a ticker symbol, Lion Philip S-REIT, CLR is the ticker symbol. Okay, if your risk profile is more aggressive, you find that maybe blue chip too boring and you don't like the dividend, you want to have a high growth that kind of ETF, you can look for some of the regional tech. Okay, there are quite a number of regional tech in listed on Singapore Exchange, right? And this regional tech basically you give you additional alpha, right? But of course, the risk would be there tends to be much more volatile. The share price can go up pretty fast and also can come down pretty fast. You have a CSOP, CSI Star, and also China Next 50, and also Hang Seng Tech ETF. All right. And if you are more conservative, you are looking for some ETF, low cost fund to help you to maximize your return compared to your cash on your bank, right? Because at the present moment, the fixed deposit and also on the bank interest rate is pretty low, between 1% to 1.5%. All right. You want something more to beat the inflation. You can look for some of the fixed income ETF over here. There tends to be more defensive, less price volatility, and also the key objective would be capital preservation and at the same time optimize your return a little bit compared to your cash. Okay, if you want to have some long-term hedging the inflation, you are able to invest in a gold through the ETF instead of buying a gold bar, keep at your home because you still need to have a storing cost. Also, you also need to make sure you keep in a proper place to prevent theft or prevent loss. You can actually buy paper gold. Paper gold basically is the SPDR gold share, right? This is a ticker symbol, GST. They are two different currency class. You have a SGD class and also have a USD class. Okay, and for the bond side, ABF Singapore Bond Index A35 is one of the bond ETF. All right. So before I move on, all right, now I come to the lucky draw number one. All right. So to make sure every one of you follow me closely, and at the same time, if you answer correctly, you should be able to get the prize there. So which asset bucket on the SGX include the CSOP IHS REIT? So A is a local blue chip, B regional tech, C real estate, D defensive and fixed income. right? So you can type into the chat box, and we will, if you answer correctly, there will be a winner randomly picked, right? They will announce the winner later. Okay, so I hope every one of you have entered your answer over there. I'll move on. I'll announce the result, and the winner will be notified through the chat group accordingly. Okay, so the answer is real estate. All right. So I move on to my presentation. So I'll go into some of the example of the ETF listed on SGX. All right, I will start off with the REIT first. So at the present moment, there are total 5 REIT ETF listed on SGX. 5 REITs. All right. So these are the REIT. As an example, you have a CSOP IHS REIT SRT giving us a 5.9% dividend yield now. Lion Philip S REIT CRR 5.42%, and Amoa Street Trading Asia REIT CFA give us a 5.26%. Later, I will show you what are the differences between all these REIT. Okay, one of the advantage of buying ETF is the bid-ask spread. Okay, when you buy the stock or buy the REIT itself, some of the bid-ask spread can be 0.05 cent, right? But when you come to the bid-ask spread of the REIT itself, so for the ETF itself, generally actually is much more tighter. In others words, you will have an immediate cost reduction in terms of bid-ask spread. Okay, so there's a pro and cons when you are buying the ETF. Okay, buying the ETF will not allow you to pick and choose the rate you want. When you buy the ETF, you are going to buy a basket of the REIT, be it a good rate, be it a bad rate, undervalue rate or overvalue rate. You don't have choice. You're basically buying everything. All right. So this is different from doing the individual stock picking. But on return, using the ETF basically can reduce your portfolio volatility and reduce your idiosyncratic risk. Okay, so at the present moment, okay, one of the things that we need to look at the whole market condition, whether REIT at the present moment is a good time to enter. Okay, this is the distribution yield chart and spread versus the 10-year Singapore government bond yield. Okay, at the present moment, S-REIT yield based on market weight give us about 5.92% compared to the 10 years SGX, a government bond yield of 2.03%. The difference of this is we call the yield spread. Okay, the yield spread, in others words, is also the risk premium. What would be the risk premium investor would like to take to invest in the S-REIT itself? Okay, so we have this chart published by the REIT Savvy. Right, if you want this report, you can send me the separate note. Right, I can send you this REIT Savvy report separately. Okay, so we track the 10 years SGX yield. You can see that during last time when you back in 21.7 and 21.8, SGX yield, 10 years yield is about 2%. Okay, at the present moment, also close to 2%. Okay, and moving forward, if the US Federal Reserve cut the interest rate, is expected this 2% you continue to drop because previously in 2020 and 2021, the SGX yield dropped to less than 1% previously. Okay, whether we will come back to this day, we do not know. All right. So if you are holding a lot of cash and parking your money under the Singapore government bond or Singapore saving bond, you probably will be receiving this kind of yield at the present moment. Now, uh, at the same time, the whole S-REIT sector itself giving us about 5.92%. And you can see that there is always a spread. There's always a difference. Whenever the spread widen, we call it spread widening. okay? And there will be the rally of the REIT price. When there is a rally in the REIT price, the yield will automatically drop, okay, to close the gap. They have to close the gap. Now, at the present moment, you can see from here, the gap also start to widen a little bit, okay? There are two ways this gap can be widened. One way is the rate continue to generate the higher dividend moving forward. Okay, because under the low interest environment, they are able to have a lesser refinancing cost. Then in return, they will have a higher dividend yield. When the yield goes up, and this one way, and the other way is when the interest rate coming down. Okay, when the gap widen, the rate sector will rally. Okay, now at the present moment, we are trading on the upper end of the yield spread. You can see from here, the average is 3.67%. Okay, this is the average. At the present moment, the S-REIT yield spread is above the 10-year average. Okay, what does it mean? This means that at the present moment, the yield spread become a little bit more interesting, right? They are not, the REIT price itself, they are not you can consider slightly undervalued. Okay, this is what it means. Okay, so it's a good time to do some shopping on the REIT itself. And how to do a shopping. Okay, instead of doing the individual REIT picking, you can use the ETF. You can use the ETF to invest in REIT sector. Okay, now I move on to the next report. This report published by the SGX. Okay, there are total 5 REIT ETF over here. I just want to show you the difference. You have a Lion Philippe S-REIT ETF. You have a CSOP IH S-REIT ETF. Okay, and based on the geography, Singapore 100% means that 100% of the 19 holding here, you can see that number of holdings, 19 holdings here, actually listed on Singapore Exchange. Okay, this is on listing place. Okay, for CSOP IHS REIT Leader ETF, 23 of them listed on Singapore Exchange. Okay, 12-month dividend yield. This report was published in April, so now the number has already changed. You can see that actually CSOP IHS REIT Leader ETF have a slightly higher dividend than the Lion S REIT. And the dividend payout will be semi-annually, which means that every 6 months, they will pay out the dividend. Okay. And this is a total expense ratio, 0.6%. Just like I mentioned that there are some expense ratio compared to the unit trust, the expense ratio is relatively lower because normally unit trust, REIT unit trust, have an expense ratio more than 1%. Okay, so you can see that actually ETF have a lower expense ratio. And this stock code CLR for CSOP itself, they also allow you to use USD to invest in the REIT. Okay, and top 5 constitute on this ETF. You have a CapitaLand Integrated Commercial Trust, CapitaLand Ascender Street, Mapletree Logistics Trust, Capital DC, and Mapletree Industrial Trust. Okay, so more or less the component they are more or less the same, but the allocation they are slightly different. Okay, now there are the other 3 REITs. Basically, they have overseas exposure. Okay, for Amoa Straight Trading, 65.2% of the underlying actually traded on Singapore Exchange. 6.1% of them traded on Bursa. 12.7% traded on Hong Kong Stock Exchange. Okay, have a India, Philippines, South Korea, and so on and so forth. If you want to have a regional diversification, okay, you don't need to go to Malaysia and invest in the REIT, or don't need to go and do research, go and look for the Hong Kong REIT itself. You can diversify your REIT exposure using this ETF. Okay, totally they have a 45 holding, and the 12-month dividend yield is 5.54%. And this ETF, they pay out the dividend every quarter. Okay, and you can see from here that the top 5 holding, they are different. As per usual, the Ascender Street, CapitaLand Integrated Commercial Trust, these are all a Singapore-based REIT. Link REIT actually listed on Hong Kong. Embassy Office Park REIT actually listed on Australia, if I'm not mistaken. Okay, or some other country, I cannot remember which one. Capital DC in Singapore, right? And Philip SGX APAC dividend leaders, 47.87 from Australia. Okay, about 11% from Hong Kong, Singapore 41%. So if you like Australia property, or you would like to have an Australia renter, right? You can look at this ETF. Total, they have a 30 underlying, and but a dividend yield will be lower. Okay, 4.39%. And Link REIT, Hong Kong REIT, Central REIT is the Australian REIT. I actually visited their property there before when I visit Australia, and also Stockland also is the Australian REIT. Okay, the last one would be the UOB Asia Pac Green REIT ETF. They have a Japan exposure. Okay, close to 30% have a Japan exposure, and they're using the green theme, right? Green. Okay, some of sustainability management over there. Their total they have 50 REIT underlying, right? And same thing, CICT is the largest. You have Central, Stockland, Link REIT, GBT Group. Okay, so the dividend will be lower because have some, but in general, the dividend from the REIT itself from Japan will be slightly lower. Japan and also Australia will be slightly lower than the Singapore REIT. Okay, so there are total 5 REIT for you to choose, REIT ETF for you to choose from. Okay, now I will show you another type of asset class beside the REIT. Okay, one of them would be the, okay, now okay, before I show the rest, I will show you how to find the information, right? If you want a lot more detail, okay, you can come to CSOP. Okay, just Google type CSOP IHS REIT leader index ETF, and you come to this website and they'll show you the holding. Okay, these are all the holdings. Okay, under holdings here, you have Capital DC, you have a Ascenders REIT, you have a Capital Land Integral Commercial Trust. Page 2, you have an ESR REIT, you have Star Hill Global. Page 3, you have a CDL Trust, you have a Capital Land China Trust, and Far East Hospitality Trust. Okay, so do take note that the disadvantage of using the ETF, you cannot choose what you want. If you don't like China, you don't like any exposure to China property, too bad. All right, because Capital Land China Trust has 100% of the exposure in China. If you don't like something in maybe in Australia or Japan or India, right? Too bad. When you invest in the ETF, you have exposure to India. When you have some exposure in India, you exposed to the forex, right? When if a Sing dollar continue to be so strong, basically all the dividend generated from the overseas source you'll be lesser. Okay, so you just can come to this website, look at the performance, look at overview. There are a lot of information on this website. Okay, now if you are a conservative investor, you want to look for a bond and you want to understand what are the bonds under this ABF Pan Asia Bond Index, right? You just come to this website and you look at the overview, look at the performance, then these are all the holding. Okay, so basically this bond is itself is pretty conservative. Majority of the holding, they are actually owning the Singapore government SGX, right? You can see that the weightage 1.06% is very, very diversified, and allocation is very, very small. All right. So what are the risks? The risk is if a Singapore government there is a drop in a credit rating, right? Definitely the share price will drop, or the ETF price will drop. Okay. So click on the daily information. Okay, I'll click on here to show you what are the holdings inside this REIT. Okay, so these are all the holdings under the REIT. Just imagine there are, I think, more than, there are a lot, 200. There are a lot. So it's pretty diversified. Okay, you have a Singapore government bond. You also have a Philippine bond. You have a China bond. You have the Thailand government. Okay, you have Philippine government. Okay, so it's pretty diversified across the whole Asia. Okay, this one is the ABF Pan Asia Bond Index Fund. All right, this one is for more on a for conservative investor. Okay, let's look at the performance. Right, if you want to beat the inflation, this may not suitable to you because if you look at the performance, 10 years performance, analyze, this fund only give you 2.3%. Okay, only recently for the past 3 years, they give you analyzed 4.1%, but if you're holding for long term, it's 2.3%. So you need to understand your own risk appetite, understand your own objective. Are you going for yield? That means maximize your cash return, or are you going from the capital preservation? So bond is very good for capital preservation, especially they are investing in a lot of government fixed income over the long term. Okay, now the next one I'll show you if you want to invest into the Southeast Asia, you want to invest into Malaysia, Thailand, Philippines, but you do not know the stock under those countries, you can take a look in the C-Stock IH Southeast Asia Plus Tech Index ETF. So what are the instruments there? Okay, you just come here to look at holdings. Okay, total they have 30 securities under this ETF. Okay, and they diversify into different sectors. For Southeast Asia, you have a technology sector, you have a consumer discretionary sector, communication sector, industrial sector. And what are the stock under this ETF? Okay, you can see from here, you have a technology sector, Wipro, Delta, this one is from Thailand, C, most of you should know C, and Grab, you definitely know about Grab, all right? You have a Venture Corp, you have a Sign Derby, you have a Go2, GoJet, you have iFast Corp, okay? And so on and so forth, right? They are the you have a Malaysia, for example, Malaysia Pacific Industrial, Hana Microelectronics. Basically, this ETF itself, they'll look for the top 30 security in the Southeast Asia, which focus on the technology. Okay, now I move on to show you another one. Okay, if you want to invest in Japan, you are interested to find out how AI can help you to manage your ETF portfolio, right? Lion Nomura Japan Active ETF. So this is actively managed, and the AI is helping the fund manager to do the active management. Okay, so this is the price of the ETF, and let's see what are the holdings and what are the performance. Okay, this is a 3-year performance. You can see that when the IPO this ETF, the IPO price is $1. At the present moment, the price has already hit $1.57, close to 60% growth since the IPO, right? Whether this will continue to grow this way, nobody know. That's the reason that when you build your ETF portfolio, you need to diversify to different asset class also. Okay, and what are the holding on this Japan ETF? You have Hitachi, heavily weighted at 9.1%. You have Tokyo Electron, Mitsui Fudosan, Asahi, Aeon, NEC, so on and so forth. All right. Again, ETF, you just need to look at you can download all the underlying, you know exactly what company and what stock you are investing. Okay, and these are the sector breakdown. So that's why ETF is very good for diversification into a different sector. Okay, now next one would be, okay, some of you have a very bullish view on the China EV, right? This Amoa Trading MSCI China Electric Vehicle and Future Mobility Index ETF. So if you want to invest in future, right, on the EV or future mobility and so on and so forth, right, you can look for this REIT, okay? And these are the holding. You have a CAT. This is the battery supplier for the EV, and I think the world largest, okay, 10% weightage here. You have Geely Automobile Holdings, okay, you should know this one. You have BYD, you have Li Auto, Neo, Qinghai, Salt Lake, okay. Basically, it's quite China heavy takeout holding because China actually is leading in the EV space, all right? So you can take a look on this one, do some research. Okay, so there are many REIT you can choose from. Sorry, not REIT, ETF. Okay, now next, how to construct a portfolio? We have so many options to choose from. and how should you get started to construct a portfolio. Okay, this few slide will be very important. I hope you pay special attention because this is how you can DIY your own ETF portfolio. Okay, first thing first, when you come to investing, we always use a core and satellite strategy. Okay, core portfolio basically you use it for long term. You don't buy and sell the core portfolio. You just hold it there, and hopefully over the long term they'll give you a growth at the same time they give you a sustainable dividend. Okay, so this is a core portfolio. Satellite portfolio is more on tactical, short-term, thematic. Okay. And whenever there's an opportunity in the market, for example, at the present moment, S-REIT sector is currently trading at a very low valuation. Okay. And at the present moment is pretty attractive. You can buy S-REIT at a ETF at the present moment as a satellite portfolio. Okay, when the whole market recover, the share price go up, then after that you can do switch to another sector. Okay, so in short, core portfolio basically will be focusing on those long-term holding, and satellite portfolio will be short-term trading. All right, it can be 6 months, can be 1 year, can be 2 years, but long-term you just buy and hold until you meet the retirement, and normally you don't do the active trading on the core portfolio, right? So instead of selecting individual stocks, right? Maybe you need to select 50 stocks for diversification purpose. You can utilize REIT to help you to achieve the diversification objective. So in short, basically you do not need thousands of complex products. What you can do is just understanding the ETF in depth, and you just mixing all these four local building blocks. Basically, you will reduce the portfolio volatility of your investment portfolio. Okay, and at the same time, you also can achieve a target yield. Okay, now how to do? Okay, to take note of the concept, you always have a core and satellite. Okay, first of all, you have to understand your own risk profile first. Okay, you have to do your risk profile analysis, right? There are many software online that you can help you to do the risk profile to see that whether you are able to ride through volatility, whether you have enough time horizon to really take on the risk. Okay, so first thing first, risk profile. You have to identify whether you are conservative in nature or you can take on some risk. Okay, balance risk profile and also the aggressive risk profile. Okay, so each of them have different strategy and also have different asset allocation. If you are getting close to retirement age, you are conservative in nature because you can't afford to make any mistake and you can't afford the market volatility. You want to preserve your capital, protect your capital, and at the same time generate the higher dividend yield compared to the cash interest, right? Then majority of your holding, you should be bond in nature, because the price volatility of a bond itself is much more lesser than equity. If you want to hedge your portfolio, you can allocate some percentage. Okay, here is just an example, 30 only, right? You can adjust accordingly based on the risk profile. Maybe you just allocate 10%, 20% to go to hedge a long-term inflation. Okay, because no matter how, you have to hedge your portfolio over the long term, because inflation, if your inflation rate is higher than your bond yield return, okay, your purchasing power will be eroded. So overall, your portfolio, the objective is to beat inflation as at minimum. Okay, so what you can do here is you can look for some of the bond ETF, right, and some of the gold ETF and construct a portfolio. If you find that overly concentrated in this ETF itself, A35 ETF, too risky, you can look for some other ETF listed on Singapore Exchange. There are a few, right? I saw some of the high yield bond ETF, or you can look for overseas ETF. All right. Now, everything I share here basically is more on the SGX ETF. But outside SGX, there are other exchange also offer the ETF solution, right? There are many solutions for us to choose from. Okay. If your risk profile is balanced, okay, you can construct a 60-40 or 50-50 portfolio, depends on your comfort level. Okay, in this illustration, you'll be a 60, 30, and 10. 60% you can use the stocks, right? You can use the maybe REIT ETF because they consider a stock, or you can use the STI, or you can use maybe the Hang Seng Tech. Okay, any equity ETF can represent a stocks, and 30% bond to give you the cushion and reduce volatility, and maybe hedge your portfolio with 10% gold ETF. Okay, so you can do this allocation. You have to decide allocation first before you go and do the individual ETF picking. Later, I will show you where to get the information, right? Now, if you are aggressive in nature, you have a very long runway. You have 10 years, 20 years, 30 years, or you just started up working, uh, just graduate recently. Then every month you are able to set aside maybe $1,000, $2,000 just to invest regularly, right? You can pick some of a more aggressive sector or ETF to invest in, all right? What you can do is you can invest in SDI because 100% equity. You also can invest in Hang Seng Tech. Okay, what is inside Hang Seng Tech? You have Alibaba, you have Tencent, Meituan, JD.com over there, right? You go to the Google and Google search for Hang Seng Tech, right? You should be able to see all the underlying under this ETF, right? And you also can put in some S-REIT, right? Over the long term, basically, you just continue to invest using dollar cost averaging strategy. Over the long term, uh, based on a past performance, your portfolio should grow, right, to meet your retirement objective. Okay, so this chart also extract from the SGX report, okay, to give you an overview, what are the REIT available on Singapore Exchange, right? These are the different asset class. You have an equity asset class, fixed income, REIT, and gold. Okay, you can see from here, the equity, you have a Singapore centric, you have a SDI ETF, you have AMOA SDI ETF, you have MSCI SDI USIC ETF. Okay, for Singapore stock market itself, you have already 3 ETF. Then what you need to do is just go in and do comparison, right? And for the Singapore income, right, just purely focus on dividend. You can look for Philip Sing Income ETF and Singapore Low Carbon ETF, right? And you also have the DLC, the leverage one, right? If you are new to investing, do not touch a leverage, anything leverage, because those are a little bit risky. Okay, if you want to have a China exposure, these are all the ETF have a China exposure. Okay, different thematic. Okay, and if you want to diversify into different region or diversify into the US, right? Or you do not know how to invest in US. Okay, there is also S&P 500 ETF available on the uh, Singapore Exchange, right? You also have exposure to India stock market through the India ETF. You have a Japan, you have a Indonesia, you also have a Vietnam, right? And if you want to diversify into emerging market, right, you also can choose this Amundi MSCI emerging market. If you want to support the low carbon and also ESG related, okay, recently they also launched some sustainability theme. Okay, CSOC FTSE APEC Low Carbon Index ETF, right? And also some of the climate action and those things. So there are many things from equity for you to choose from, right? For fixed income, you'll be slightly lesser. You have a Singapore centric, you have a China centric, you also have a regional centric. Okay, for example, if you want to look for the fixed income with a higher yield, the USD Asia high yield bond, if I'm not mistaken, giving us about 7 to 8% take out of a coupon yield. But this is traded on the USD. But in terms of the volatility itself, this bond ETF will be much more volatile than a Singapore bond index ETF because majority of them actually invested in the high yield corporate bond. Okay, but the Singapore bond index, they are investing in the Singapore government bond, okay, which is safer. And recently, Lion Global also launched a short duration bond index. This short duration, you reduce your volatility and also good for the capital preservation purpose. Okay, so these are the instrument under the universe. All right. So I will share with you I'll share with you where to get the information later, right? So before I move on, let's start the lucky draw number 2. Which portfolio profile allocates 70% of its total capital to stocks? A, the growth accelerator. B, the yield fortress. C, the all-weather engine. All right, give you some time to answer. Okay, hopefully all of you have answer, right? Now the result is the growth accelerator. Okay, before I move on to the execution, all right, I will show you where to find the ETF screener. Okay, ETF screener can be found on SGX website. You can come to sgx.com. Under the stock exchange, look for ETF screener. Okay, you can see all the ETF listed on the Singapore exchange over here. Okay, you can sort by the name, and these are the ticker symbol, the trading symbol. Okay, SBO, SBV, JJJ, JUS, and the currency. Beside the SGD trading currency, you also can trade the ETF in USD. And recently, SGX also launched in Chinese yuan, renminbi, okay, CNH, okay, Chinese yuan currency. Okay, yeah, and you can see all the stock price over here, and you can find all the document over here. Okay, and if you're not able to find a document under this screener, you can Google search, go to the individual website to search for information. Okay, and you have different asset class over here. Just now, that's why I asked you to determine your asset allocation, right? 60-40 or 70-30, right? From here, you can choose which ETF belongs to commodity classification, which one consider equity, which one consider fixed income, okay? Which one consider REIT, okay? You have plenty of the choices over here. And if you want to have a geographical diversification, you don't want to overly concentrate into the Singapore or to overly concentrate in China or India, right? You can choose the ETF accordingly to have proper diversification. Okay. And if you are focusing purely on the passive income, okay, choose those REIT with the income treatment, okay, distributing, okay, which means that they are paying out dividend, okay. Do not choose wrongly. If you choose accumulating, you are not going to get any dividend, right? That's why choose wisely, okay, based on your objective, okay. And you also can see that whether the ETF is actively managed or passively managed, okay. And you also can use your CPF money to invest in the ETF, right? There are only a couple of them you can use the CPF IS to invest, right? CPF OA. But do take note, when you use your CPF OA to invest, do take note that these are not risk-free. Once you move your money out from CPF OA to invest in the stock market, you will be subject to the market volatility, right? At least that your CPF OA at 2.5% is more or less guaranteed, right? And you don't have any price volatility. But once you invest in the stock market, be it bond or be it equity, you will be subjected to the market price changes. Okay. Yeah, this is a website SGX, all right? Okay, so another thing that I want to show you this one later. Okay, I go through this one first. Okay, so execution. Once you have, okay, I repeat again. First thing first, you need to decide what type of portfolio you want to construct, core and satellite. Okay, core is for long term, satellite is for short term. Then after that, you decide your risk profile. Once you decide risk profile, be it conservative, balanced, or aggressive, you can determine your asset allocation. Once you determine the asset allocation, then you go and choose your holding, choose all the ETF here to construct a portfolio accordingly. If you find that this list is not exhaustive enough, you can go and do some research and look for the overseas ETF. But if you still cannot find, you still need help, you can contact me separately. Okay, I'll guide you how to construct the overseas ETF portfolio. Okay, now once you have settled those things, the next thing here is come to execution. Okay, just now is more on planning. At the end of the day, you have to execute to do it for yourself. All right. So first thing first, you have to set up legally how to hold your ETF. Okay, there are two ways. If you open the account with Tiger Broker, Tiger, you can use a Tiger Broker as a custodian to hold your ETF. Okay, that's one way, right? The other way you can set up is a CDP account. CDP also can hold your ETF. So first thing first, you need to set up this thing first before you are able to trade anything. Okay, either through the broker, Tiger Broker, or CDP. Second thing is, where are the money come from? All right. So you have to determine whether you want to use a cash, you want to use a SRS, or you want to use a CPF OM money to invest. Okay. So most of the REIT, okay, all of the ETF you can use cash to trade. Okay, SRS is selective and also CPFIA is selective. Later, I will show you how to identify those ETF which can use SRS to invest, which one can use a CPFIS to invest. Okay, now the next thing would be when you place the order into the market, always use a limit order. Okay, because during the market opening, the bid-ask spread can be very wild, can be wide. Okay, so you want to control your entry price, you always use a limit order. Okay, and trade when the underlying market is open. Okay, for example, the Singapore market open between 9 a.m. to 5 p.m. Okay, in order to minimize the volatility and wide bid-ask spread, avoid placing order before the market open or after the market open. You can place it maybe at 9:30, half an hour or 1 hour after the market open, or just maybe 30 minutes before the market close. All right. So just avoid trading too close to the market open or market closing. Okay. This one this one is to make sure you are able to get a good pricing. Okay. So I repeat again. Okay, so you use the limit order over the market order. So when you place the order, do take note, limit order, not the market order. Okay, and avoid the discovery phases, because normally when the market open or market close, okay, there are a lot of opening and closing position. Okay, so do not trade at the exact open or close. Okay, let the market settle first, right? So you can set your own rule, 30 minutes before or after the market close. Okay, up to you. There's no hard and fast rule. Okay, you can set 1 hour, you can set 30 minutes, up to you. Okay, and a time zone alignment. If you are buying the ETF underlying on a Singapore stocks, for example, STI ETF, the DBS, OCBC, actually they are trading during the Singapore trading hour. Okay, your ETF also trading during that hour. Okay, so you align your trading time. Okay, for example, if you want to invest in the US ETF, if you place the order during a Singapore time, it's not a good time. Okay, what you can do is you can find some chance to really place the US S&P 500 ETF maybe at a US trading time. Okay. Okay, now I will show you another resources, which are the top 10 most purchased ETF under SRS and also CPF OA, right? These are the top 10. Okay, under equity, you have the Spider STI ETF. The code is ES3. You can use a SRS and also CPFIS to invest. The next one is the Lion OCBC Security Hang Seng Tech ETF. Just like I mentioned over here, they have a Alibaba, they have a Tencent, right? And you can only use SRS. CPFIS is not allowed because it's very, very volatile. Okay, in terms of volatility and in terms of risk is much more higher. Amoa Singapore SDI ETF, you can use a S-REITs and CPFIS to invest. Okay, Spider S&P 500 ETF, only S-REITs. Of course, cash you can use it. All right. UOB AM Ping An FTSE ASEAN Dividend Index. All right, you can use S-REITs and cash. For REIT itself, all that these three REIT can use S-REITs. Only Amoa Street Trading can use the CPFIS. Okay. I mean the top 10, all right, but you check the rest of the list. Okay. And fixed income, you have Amoa SGD investment grade corporate bond ETF. You can use the S-REITs and also CPFIS. Spider Gold Share, S-REITs, and CPFIS, right? So there are a lot of information on this report itself published by SGX. You can see that actually the is continuing growing and very diversified, close to 20 billion, all right? If you want the report, you can drop me an email, right? You can contact me. Okay. I think someone put in the chat box the registration if you want this report. Okay, so my last page, all right? So this is a summary and the next step. Okay, I summarize what do you need to do as an investor if you're interested to build your ETF portfolio. So using ETF, you can eliminate idiosyncratic single stock risk instantly. I hope by now you should be able to convince that if you want to have a minimal risk of single stock losing the money, maybe ETF is a good solution to you, okay, over the long term. S-REIT ETF at the present moment offer more than 5% yield and with a 64% reduction in the spread cost, okay, and also can beat your interest rate with the SGX Singapore security, Singapore government bond or Singapore saving bond, and even your fixed deposit rate, okay. Always remember to match your specific asset allocation strictly to your personal risk tolerance. Okay, this is to help you to build a proper portfolio according to your risk profile. Okay, I hope you by now you should be able to do it yourself. If not able to do it and you need help, you can always contact me. All right. So always think early, utilize limit order. Okay, I keep repeating again, and automate with your regular saving plan, right? If you have a very long-term investment horizon and you just invest regularly, right? Every month after you set aside some of the cash flow, right? So this is my contact, right? And my website. If you want to contact me, you can go and look for my contact number. Okay. So I will hand over back to Wan Ling, right, to continue the lucky draw.
Okay, thank you so much, Kenny, for his sharing. Now let's jump straight into our lucky draw round 3. Question 3. Which type of order should you use instead of a market order to avoid price slippage when trading SGX ETFs? A. Stop loss order. B. Limit order. C. Market on close order. Please leave your comments and then we will randomly pick one winner. All right, we're getting all the answers in. Then now we'll review the answer, which is B, limit order. Congratulations to our winner. We have one final lucky draw left at the end of the session, so stay tuned. And then now we'll open the floor to audience questions. Feel free to submit your queries in the comments section. We will address them live. And Kenny, you can also take a look at the previous comments from the users. Can try to answer some of them.
Yeah, Wan Ling, maybe you can read out question because I'm not able to see a comment.
Okay, let's have the first question coming. If the Federal Reserve resumes rate hikes in H226 or the monetary Authority of Singapore tightens its policies, could the dividend yield advantage of S-REITs turn into a high yield trap, with share price declines wiping out all dividend gains? And also another question, what are your thoughts on this risk?
Then give me a moment. Let me see the.
Okay.
Let me see whether I'm able to get the question. It's on the chat box, right?
Yeah, it's in the chat box.
Wow,
The
where is it?
first question.
Cannot find. Not able to see. Can you repeat again?
Okay, give me a second. If the Federal Reserve resumes rates in
Hello,
H226
Aning.
or the monetary auditory of Singapore tightens its policies, could the dividend yield advantage of REITs turns into a high yield trap, which share which share what? With share price declines wiping out all dividend gains? What are your thoughts on this risk?
Okay. So it's possible, right? If when you come to the dividend stock or REIT itself, uh, although you are buying for the dividend, but when the market changes, for example, I use REIT as an example. Okay. So government is anticipating there will not be any rate hike for this year. For this year, that means they're holding steady at this year. Unlikely we'll see the REIT price will fluctuate uh, violently. Okay. So most likely the REIT sector will be trading on sideways. And at the same time, you are able to get a dividend of 5.9%. Okay. So assuming the share price does not move, right, you will be rewarded 5.9% this year. Okay. Now, assuming next year, suddenly due to the high inflation in US and the US Federal Reserve, they have to increase the interest rate, then the risk sector most likely will have a sell-off, right? So when you have a sell-off next year itself, right? Of course, it depends on the degree of sell-off. If a sell-off maybe 5%, basically your dividend basically can offset the sell-off, right? But if sell-off is very severe, maybe drop by 10% or 20%. Of course, next year you sell, you see after combining the dividend itself, maybe you can see the minus 10% that kind of drop. Okay. Now the question come back to yourself, right? At the beginning, why are you investing in this portfolio and why what is your objective? If your objective is purely for the dividend generation, right? Any volatility in the market itself is not a major concern, right? Because eventually REIT itself is cyclical in nature. Okay, they're very sensitive to interest rate. Today interest rate increase, then the share price drop. The next day the interest rate will start to come down, the share price rally. So they are moving in cycle and very volatile. So first thing first, when you come to dividend investing, always focus on the so-called sustainability of the underlying of the stock in terms of cash flow. Whether they are able to generate the cash flow consistently, growth year over year consistently to pay investor the dividend. If the answer is yes, any price volatility in the market itself, because that is not the fundamental of a company, is really driven by sentiment, driven by the macro environment. Those are not a major concern. Okay. So in order to manage volatility itself, right, stick to your own risk profile, because when you have a sensitivity in terms of the rate hike, okay, the other sector, most likely you gain from rate hike. For example, bank sector, all right? So you can build a portfolio, have some allocation into REIT and some allocation in the bank itself, because REIT sector sell off, bank sector will go up, right? When the interest rate coming down, the bank sector, maybe you sell off a little bit because bank rely on the interest rate to make more money, right? Then the REIT sector will go up. So you use this kind of balanced approach to balance out all the volatility. And on the other hand, you also can use a fixed income bond, because bond has an inverse relationship with the interest rate. When interest rate goes up, bond price come down, and vice versa. Gold also same thing, right? Gold will gold will have a two objective. One is based on inflation. Long-term inflation goes up, gold will goes up. And when the USD weaken, gold will goes up also. So you build a very, very diversified portfolio with different asset classes, and all these asset classes don't correlate to each other. This is how you navigate the market volatility. Okay, Wan Ling, do you have any other question?
And then we have the second question, which is the Asia growth's been the story for years. Is it really taking off this time or crying wolf again?
Uh, It really depends. It really depends because there are just too many moving elements. By right, if you look at the past few itself, in terms of valuation of the emerging market, PE ratio and price to book, emerging market or emerging Asia actually in terms of valuation is much cheaper than the US stock market, right? US stock market at the present moment is at a historical high. Then the valuation is very rich, and the bullishness driven by the AI and also the semiconductor. The key question here is whether there's a bubble in the semicon side and also AI side. The reason being is because all these big tech, they are invested heavily the capex into this business, right? When you want to do some investment in terms of capital expenditure, right, or the infrastructure itself, you need to make sure the future revenue, they are able to offset whatever investment you have put in, or the revenue must be able to generate a profit after you have investing. The key question here is, at the present moment, is all forecast. Okay, AI, you make to change the world, you help the company make a lot of money. That is a future forecast. But at the present moment, they already throw in all the money. If the earnings come out in the next few quarters is actually worse than expected, it's not based on the original plan, there will be the sell-off on the tech sector in US, right? Then when there's a sell-off, the money definitely have to go somewhere, right? Because it's you have one market sell off, then the money you park in the Singapore no, so the bond market, or they move into the emerging market, which is undervalued, or maybe move into a dividend sector, right? Or value stocks, right? So it's very much depends on the dynamic itself, right? So what I can say then now is no one can predict what would happen to the emerging Asia moving forward. But one thing for sure, we just look at mega trend. When you come to emerging Asia, definitely you can run away from China. China is leading renewable energy. China is leading in terms of the battery for all the EV. China is leading in the EV. China is leading in the AI application. But of course, the AI research, AI, those advanced technology, they are all in US. But when it comes to application itself, actually China is leading, right? So whether the tide will kill, nobody know. But if you look at long-term plan, 10 years, 20 years, 30 years, then we have to ask ourselves, will China come up? All right. And the US dollar continue to be weakened. And now a lot of fund manager talking about de-dollarization, right? And Trump also want to have a weakened dollar. So the next question is, do we want to put all our investment into USD and the US stock market, right? Because you expose two type of risk. One risk is the USD depreciation over the long term, right? Short term, not necessary. And the US stock market is overvalued at the time being, right? And what is the upside potential of the US market versus the downside risk? Okay. So nobody can answer that, right? So my take would be, I also can answer that because I'm not God, right? The only way to play this market is to build a diversified portfolio. I have a US stock exposure, I have an emerging Asia exposure, I have a China exposure, I have a tech sector exposure, I have a REIT, I have a bond, I have a commodity, I have a fixed income. Okay, this is how, for me, I play by building a diversified portfolio with different asset classes. And this is how I advise my client to do so also. Okay, Wan-Ning, any more? Okay, I saw one question over here. When should we DCA and when should we stop? Right? Okay. Hang Seng Tech downtrend. There's no right or wrong answer. Okay, in order to use the DCA, dollar cost averaging strategy. Okay, dollar cost averaging strategy is best to use if you have so-called unlimited bullet. Okay, for example, you are gainfully employed. Every month, you are able to set aside certain amount to invest in the long term. You have very long-term horizon, and you are able to have this kind of income for you to invest consistently. It does not matter whether the market go out or come down, because one thing for sure, although the Hang Seng Tech Index, okay, because that's the ETF, it's not stock. If you are investing in stock and the stock is on a downtrend, okay, and the fundamental has weakened, do not DCA. Okay, again, if you are investing in individual stocks, fundamental has worsened or weakened, and the stock on a downtrend, do not DCA. The reason being is because the stock price can go to zero, right? Then you lose up all your money doing a DCA. But you are investing in ETF. ETF is a basket of stock, right? And ETF, they follow the index every year or every semi-annually. The ETF will be rebalanced. They will always put in the stronger performance stock into the index and replace the weaker performance out of the index. So over the long term, ETF based on the index ETF, they're always rebalancing over the long term that only the stronger can keep in the index itself. If that is the case, then you do not really need to worry too much on the DCA. But one thing for sure is you don't stop halfway. Once you decided to do a DCA, for example, you are planning for 36-month DCA, 3 years, then you have to do it consistently, right? Whether the trend is up or down, because we are looking at a total period, not because when the trend going lower and lower, that means that you are accumulating or you are investing in the cheaper valuation that kind of stock and also at the market low, right? When the market recover, when it reverse to uptrend again, basically you have maximized your return. Okay, so it really depends on the situation when you're doing a DCA. Okay, so the Singapore market has seen strong return from the China asset ETF this year. Will this return continue to rise? Okay, due to the recent sell-off on the China tech stock, right? You can see that actually Hang Seng Tech also have a sell-off. Trend, the technical analysis is important, right? Over the long term, of course, I have a bullish view over the long term based on the business, because eventually China very likely will overtake US as a global economy. And also there are a lot of technology and a lot of business that can take over US over the long term. Again, long term, right? Long term wise, I am bullish on China, but short term, due to a lot of noises and US-China trade war. That's why they have a lot of volatility. So if you invest in the emerging sector itself, just need to be prepared to ride through the volatility, right? But on another hand, that's the reason why the Singapore stock market they performed quite well recently, because basically none of the stock market can consider safe, right? US has its own US issue, right? You have a war issue, and that's why some of the money come to Singapore, right? Because of Sing dollar, a triple A credit rating, and the stock market, Singapore stock market has been very resilient. Okay, based on your understanding of market forecast for second half of 2026, what's your suggestion for SGX ETF investing? Build a balanced portfolio with a geographical diversification and also with the different asset classes, right? This is what I'm currently doing now. I am not focusing onto one single asset class. That means I am not investing everything under the REIT ETF or not investing under the emerging ETF or China ETF. No, I am diversifying to US, China, fixed income, gold, commodity, REIT, dividend stock. I am diversifying because nobody can predict how the world evolve, right? And we know that one thing for sure that we know the money will be moving from one asset class to another asset class. After certain sell off, they move to another asset class, right? Because the fund manager in this world is playing this game. They always move the money around to look for high yielding asset, and especially they are always looking for the stock market which is undervalued. And they go in first as a smart money and just wait for recovery. This is where you can get the maximum return, right? The best time to invest in the market, like what Warren Buffett said, is when everybody is in fear. So when there is a big sell-off, when the market is undervalued, extremely undervalued, and also hitting a historical low, and most of the retail investor is very scared of investing in market, but that's the best time for you to pick up good company, good stock at a cheap valuation, right? So you can use this kind of strategy if you're aggressive investor. If you are not able to really do the picking itself, not able to understand the valuation, you don't understand what is price to book, what is the price PE ratio, right? And basically just using an ETF, building with a different ETF with the asset class will be the better choice. All right. So one thing, Wan I hand over back to you.
Okay. Thank you so much, Kenny, for your amazing sharing. I'm sure everyone here has gained some invaluable insights from his sharing. So now let's bring out our final lucky draw question for all tigers. This is your last chance to win today, so get ready. So which time period does Kenny recommend for trading SGX ETFs? A. The first minute after market open. B. The last minute before market close. C. During the underlying market's normal trading hours. Keep your comments coming. All right. Let's review the answer. The answer is C. During the underlying market's normal trading hours. So congratulations to all of our final winners. If you won today, our team will be reaching out to you shortly. And as we wrap up today's session, a very big thank you once again to Kenny for sharing such valuable insights and roadmap with us. For those of you who would like to continue learning from him, you can follow at Kenny_law and at Read Savvy at tothemoon.com and follow his YouTube channel at Kenny Law Financial Wisdom. You can also visit his website readsavvy.com where he provides deeper analysis and resources on REIT investing. Next slide. And for those joining us for the first time, a quick introduction for Tiger Brokers. Tiger Brokers is a leading global online brokerage firm. Beyond just trading, the Tiger community provides a wealth of expert commentary on market trends, industry news, and high conviction investment opportunities to help you stay ahead of the curve. And next slide. For viewers who are interested in exploring investment opportunities further, you may also download the Tiger platform, open an account, and fund it to access a wider range of investment products. Our flagship trading app, Tiger Trade, has over 90 million users with more than 1.9 million active investors across many countries. It empowers you to trade a wide range of securities in the US, Asia, and Australia. And that's not all. We also have powerful tools to enhance your investing experience. We have very handy tools like the Tiger AI, Boss Card, and the Cash Boost account. So with Tiger AI, you can analyze market data and generate insights in real time. And with the Cash Boost account, you can get at least 20,000 SGD to enlarge your equity and ETFs buying power. So if you're ready to take the next step, check out Tiger today. Next. So thank you everyone for joining us today. We hope you found the session insightful. If you want a recap of today's live stream, you can always search for the recap video in the Tiger Trade app. We look forward to seeing you in the next one. Take care and happy investing. Also, if you would like to learn more from Kenny, please follow and subscribe to his channels. Make sure you get updated to the recent news from him.
Thank you. Bye bye, everybody.